Here. All right. Well, let's just kind of, Larry, let's just start with an introduction of who you are, what your specialty is, what your superpower is, and how we're going to be conducting this series of interviews and panel discussions that we've kind of set up, you and I.
Absolutely. I like the superpower thing. I think I'm going to stick with that. That's a
Well,
that's a good
I
one.
tell everybody you're a recovering accountant, and usually most superheroes have that one bad vice, and well, you used to do accounting. I mean,
Yeah, yeah. But reformed, getting better now, getting through the
right,
program.
right.
So awesome. So for those who haven't had the pleasure of meeting, my name is Larry D. West III. I own a tax strategy and consulting firm that's here in Dallas, Fort Worth. And that's essentially what we do: tax planning and tax strategy from a proactive perspective, not the old way of, hey, hand me your stuff and here's what you should have, would have, could have done. Really excited about this platform, though, because we're going to uncover a lot of cool things. In the name tax-free cash flow, I think a lot of people like the tax-free side of things. But I think what you'll essentially understand is opportunities for investing, opportunities for wealth building, and opportunities for protecting that wealth from your biggest expense, and that's taxes. So I'm excited to dig into a lot of what we'll be uncovering.
And that's one of the things, Larry, that it kind of really comes back down to what people think accountants do and what accountants actually do. I mean, my perception early on of accountants was, you show up with your shoebox full of receipts and everything else, and you throw it on the table, and they kind of sort through it and scramble through it, and they help save you money, right? They do your taxes, and they always do the most efficient way to do it. They've got all the tax strategies, they know all the stuff. But why isn't that the reality of what really happens?
Yeah, so that's really good. A really good question, I should say. And a little bit of it has to do with this kind of old school culture of accounting, and also a separation of accounting and tax, right? Most people assume CPA, certified public accountant, they're doing my books, they're doing my tax, those two marry together. But not a lot of folks are well versed in both of those areas. So that old school way of, like I said, hey, bring me all your stuff, do the tax return. A lot of firms were essentially tax meals: prepare the tax return, get it out the door, on to the next one. And then when tax season is over, they're running for the summertime and hiding under a blanket because they don't want you to bother them.
Right. It's
But
funny.
now we're,
I
oh, go
just
ahead.
did something really quick. I just hit Google and I just looked up the word accounting, and the accounting is the action or process of keeping financial accounts. So when we talk about our accountant, we're really only talking about someone that is keeping a financial record of what we did. It's not creating a financial game plan. That's pretty
Exactly.
clear, even according to Wikipedia.
Yep, yep. And so people essentially need is the strategy behind it. Now there are some of us out here with that superpower, as you just mentioned, but that's exactly what you're looking for. It's someone who has an accurate picture of your financial world, but then they can layer on the strategy to make sure you structure things in a way where you're holding on to more of your wealth.
So let's start with that. So when you're looking at it, and when you got started in accounting, you were sitting there going, "Hey, I'm going to be an accountant," and you know, I don't want to see any of my friends and family from like 2 weeks before Christmas until like spring is sprung and it's all over. But what was it that you what how was your path that you really kind of from the accounting world did a left into where you're at now?
Yeah, so I had an interesting path where I started learning on the strategy side, came into the accounting piece, and quickly ran right back to strategy. So I thought I was leaving my MBA program, high profile investment banker, going off to New York, Chicago, somewhere. That didn't exactly happen because I landed in Abilene, Texas, and just in that there in Abilene. And so I had an opportunity to work for a financial planning firm over in that area. And essentially, I had the task or the job of researching what the strategies that they were implementing, researching what that meant from the tax side of things, would just so happen to be the most important. Clients would often say, "Hey, this sounds good. This sounds great. What is my tax bill going to look like after this is done?" And so that's what they relied on me on. Then I went and worked for traditional CPA firms in the trap that you just mentioned, where you get caught in the tax mill. And you essentially don't have a life for 4, 5, 6, 7 months out of the year. And quickly realized not a lot of value happens there because tax prep is simply memorializing the old stuff that happened. There's no forward thinking strategy that's layered on top of it. And so as soon as I had the opportunity, I came right back to the strategy side because that's where all of the value is, or most of the value, I should say.
Yeah. And really, that's where, we hear of all of the things that, the corporations don't pay taxes and they don't do this and they don't do that. And, the reality is that may be true of the corporation itself, but the jobs that are created, the things that happen out of that. And real estate is obviously one of those areas that a lot of people have, put a lot of money into, including the people that write the IRS tax code. So they've made sure that there's ways to value that. But the other thing that a lot of people forget is that the easiest way to incentivize people is to look at what is the opposite of the incentive. And there's the man of the hour. What is the opposite of the incentive, and what is the deterrent if you don't do that? So you've kind of looked at it from the standpoint of, hey, let's get to the incentive side, not the deterrent side. And now we have my handsome friend, Mr. Hope Johnson, with me. How are you, Alvin?
Shannon, I'm great, man. Where you been?
I've been hiding under a rock, man. I've just been trying to hang out and be cool,
Well, I've been under the wrong rock because I've been looking for you.
Well, the only thing I know about you lately is don't let you drive my car. How are you feeling, man?
Man, never better. Never better.
Good.
Yeah, I don't need to be driving your car. I need to fly your plane.
Well, hey, you are here because we are trying to talk to some people about tax strategies, what Larry does. We kind of got into why he's doing what he's doing. And, you and I both develop multifamily, but you have a little bit different angle on how you do it and what the tax benefits are of that. And so we just really kind of want to get some thought process going with you on what it is you do and what tax strategies you're employing to do that. And then Larry's going to throw in the verbiage there so we all keep straight, stay out of the IRS's crosshairs. But give us a little bit of background give us a little bit of background on who you are and what you do and how you tax strategize that to be tax efficient.
Shannon, thanks. My name is Alvin Hope Johnson, and I am in the DFW, Dallas-Fort Worth area. We're a developer, as Shannon said, and we're working towards building a lot of units in the next 5 years. My number is 20,000. And the reason I was late is we've got guys in here today from all over the country bidding on our project here in Princeton, Texas. So super excited. And to use some of the tax strategies, Shannon, some of the things that we've done is partnering with individuals that have had massive gains in their income, and they've been looking for areas to park money to get some depreciation advantages, along with some return on their capital, and not just parking in a bank and paying a lot of taxes. So I never get into the benefits of tax advising anyone of what their tax advantages are. That's why we pick up the phone and call Larry and let them talk to them. But just knowing that we have vehicles that individuals that have had those kind of successes in their life, business, whatever, with financial gains, where they can park their money and receive a significant return on their capital while doing good, receiving some advantages from a professional like Larry with the tax advantages. That's what we like to provide.
Well, the other thing too that you do, don't you have? I mean, you have the Hope Foundation, right?
We do.
So you have quite a bit that you do in the nonprofit.
Yes.
As well, right?
That's correct.
I mean, that's not just a do-gooder moniker. There are tax advantages for that. There's reasons why you do that.
Yes.
But there's also some pretty serious tax savings and implications that happen when you do things in that process. Tell us a little bit more about that.
Well, some of the things that we've done in our developments that are owned by the nonprofit, where we have partnered with individuals, and we've been a minority partner, 0.01% in a limited partnership structure, allowing us to pass on 99.9% of the depreciation to all the investors. So that's one big way that the nonprofit can be advantageous with us partnering with investors. That's how all the tax credit deals are done. The only reason these big institutions buy tax credits is for the depreciation, not because they want to help people with affordable housing.
Right.
So they get 99% of that write-off, 99.9% of that write-off, because the nonprofit is a 0.01% GP. There are also some states that allow a nonprofit to have ad valorem property tax exemptions. So when we have those ad valorem property tax exemptions, we can actually provide affordable housing to residents at a reduced rate. That's one advantage to the residents. We don't pay any capital gains when a nonprofit sells properties. That's a huge deal. But again, that money doesn't come to me. That money goes to the foundation, and the foundation uses those proceeds, excess proceeds, to further the mission of providing safe, decent, sanitary housing to the economically challenged and workforce communities across America. So there really are some big advantages in doing it that way. We don't use those advantages to inure ourselves or to make ourselves better. We use those advantages to make it better for the residents that we serve and the communities at large.
So Larry, break that down for us. If Alvin has set up the nonprofit, no, this is the good thing, right? Because Alvin, you and I speak the same language, right? It's 30,000 feet at about Mach 2, right? And then you got Larry in here batting cleanup and putting everything in the box, and there was 37 steps to first base, and then he rounded the corner. But Larry, break that down for us and tell us exactly what that means to set up a nonprofit, to have the nonprofit be a partner in the deal, to have the investors get the incentives on that. What does that really look like, and how difficult is that to do?
Yeah, that's really good. I'm going to start with this because I don't want to glaze over that really important fact. When you do insert the nonprofit there, there's a very specific mission that organization is set to carry out. And so we don't want people to jump into it and think they're going to create a nonprofit just for the sake of rolling a couple of dollars over. That organization has to carry out the charter and the mission that it told the public it would. But essentially what you just heard, if we boil that down, is its mission, as Alvin articulated, safety, affordable housing for the community, right? But that presents an opportunity for investors who love tax-free cash flow, hence the name here, and an opportunity for them to receive 99% of the depreciation. You partner with that nonprofit organization, it fulfills its mission of providing affordable housing. The investor then fulfills their mission of investing in a project that produces cash flow that's very tax efficient with a huge wave of depreciation that comes back to them. If I had to boil it down to simple terms, that's exactly what we're looking at.
So then, Alvin, what happens there, if I'm catching this correctly, is you guys are a nonprofit that goes into a community and you negotiate certain things, and let's say that they're not going to charge you property taxes on it, which in Texas that's a huge deal, right? Because property taxes.
We don't get that advantage in Texas.
You don't get that advantage, okay?
No.
But in a community, you're able to get certain tax breaks that then you are required to pass on to your tenant. But if it's not an expense on the cash flow side and it's passed straight through to the tenant, you're still getting the same profit. You're able to offer a better rent rate, right? And you're still able to provide the asset, provide the depreciation, provide the cash flow, provide all those things. You've created a mission that then helps it become more affordable and more targeted to a specific monetary level of people, monetary population, where you're able to then make that something that works, right?
That's correct. And so the incentives that we receive, as you said, we don't pocket those. We pass those on to the resident, allowing us to have an affordable community, which fulfills our mission. And we call it doing good while doing good. When we partner with people, they get to do good by helping us fulfill our mission of providing safe, decent, sanitary housing to the economically challenged and workforce communities across America. That's the mission, and not just economically challenged, but workforce communities.
Right.
That's everybody that's got a collar on.
Right.
So but in being specific with that, there are certain set-asides that we have to do for the units. So we have to set aside so many units available for 50% AMI, 80% AMI. And when we do that, that qualifies that project as a affordable community. And most times there's a land use restriction agreement, LURA, that's put in place to protect that. And when that is in place, meaning that those units will always be set aside for the time of that LURA, then there are never any questions about the nonprofit involvement. And then the ability for us to be that 0.01% partner and pass those savings on to the
So
partner.
now, when you're looking at that and you're talking about your AMI, explain AMI to us.
Okay. So area median income is AMI. And I'll tell you, in a market like, we're doing a deal in Green Bay, Wisconsin, the average area median income for that market is $94,000 a year. So call it 100 grand, average area median income. For affordable housing to kick in, we have to have some units set aside at 50% AMI, meaning people make 50,000 a year, or 80% AMI, 80,000 a year, and typically 20% of those units are set aside for that. And so if we set those units aside for that, then that would qualify that deal as an affordable housing project and allow us to take that property off of the tax rolls in Wisconsin, which is not a big deal. But we're not going to do that there because the city of that particular city actually gave us TIF dollars. So they gave us tax dollars that they've collected from businesses in the area and said, here's $3 million, please build this project. You're going to have a $10+ million assessed value. So they know that by taking the money from other businesses, giving it to us to build a $28 million structure, that deal is going to pay them property taxes to pay them the money back long-term that they gave to us. So that's just one way to spur development.
So then let's talk about AMI. When you're busy,
I'm sorry, my guys are leaving. Yeah.
That's fine. So when you're talking about AMI, so let's go back to that. So when I have a guy that I'm going to rent 20% of my units, and I'm going to assume half of those are at 50% AMI. So that guy's going to be at 50,000. What's the percentage income that I can charge of that? Is it 34% of their income for
about 35%? Yes.
Okay. So then I'm just going to think with my calculator real quick, times 0.35. So I can charge $1,500, $1,458 for my 50% AMI in that particular area. What are rents in that particular area?
Well, in that particular area where you've got a $100,000 AMI for a 1-bedroom unit, it's about $1,400. So that guy is good.
So you're really creating that under the benefit of a affordable housing, and you're creating it in an area where the average median income is high enough that the AMI and your rents are kind of in line anyway. So you would have built this and rented this for $1,500 anyway. So you're getting a $50 a month credit, really hitting that mark, providing goods and services for the community, creating the nonprofit game plan, marching out your goal. I mean, the list is getting really long here, Alvin, of all the things that you're able to accomplish by paying attention to market areas and certain areas that you can do certain things in.
That's correct.
So
the place where that doesn't work is where the area median income is $30,000 a year.
Right.
That $30,000 a year, that 50% income bracket is 15 grand a year. 30% of that, they can pay $200 a month in rent.
Right.
Typically, that's when a Section 8 voucher kicks in and pays the difference of the rent for that particular tenant.
And the reality is, though, Alvin, usually in those areas of $30,000 AMI, that's because there's not a high job growth market there,
Correct.
which means you don't have a high skilled worker pool there.
Correct.
You usually in those areas you have dying communities.
To some degree, yes, Shannon. Dying, yes. Maybe not from people leaving, but I can tell you the hope is gone. The love is gone.
I can tell you $200 a month, Hope Johnson's not showing up. I mean, you know.
Well, they need a little hope.
Yeah.
I mean, and that's deplorable because you think about $30,000 a year. Shannon, what's the average income in America?
Right.
$38,000, $40,000 a year.
Yeah. Yeah.
So they say what 60? I don't know what the percentages are, but I bet you it's over 50% of the people live at or below the poverty line across the U.S.
Yeah.
Google that real quick.
I'm Googling it right now. So Larry, jump in here while I Google this.
Yeah, absolutely. So Alvin, one of the things that we didn't quite touch on is when you provide this kind of housing and resource, affordable housing, I guess we'll call it, from an investor perspective, some people may be a tad bit ignorant to the fact and assume that, hey, it's affordable housing, that means lower returns, not really that good of an investment than say if I went somewhere else. Can you speak to that a little bit? What do returns look like for investors for projects that you work on?
Man, I'll tell you, on our projects that we bought and repositioned, those returns, our investors made 500% on their money. I mean, in 12, 18, 24 months. And then we've got 6 of those deals that we have finally refinanced all of them for the second time in about 8 years. And each time they pulled out cash and cash. And finally, this time we just bought them out. But those returns have been stupid for those guys. In the newer deals that we're doing, our returns we are forecasting about a 21% return over a 3 to 5 year period. And yeah, that's pretty staggering.
Now, when you're talking about your returns, you're not factoring in, just the disclaimer, you're not factoring any tax benefits or tax savings that individual investor would have, because everybody's tax situation is different.
Correct. That's correct.
Right. So let's take this.
And then if Larry boiled that down, Shannon, you're right. If Larry boiled down, so you invested $1 million in this deal and it paid you a 3.25 multiplier. So that means you're going to get back $3.25 million on your money in 5 years, 31% return, something like that. That is not calculating the depreciation that we're going to get the first 5 years on that. That depending on how much of that particular investment, that particular $1 million bought, that person could receive 85% of those dollars tax exempt.
Right. Now,
I'm
let's
not
just
gonna
be clear,
calculate
Larry,
that.
when we talk about depreciation, where does that apply to in a person's capital stack or in their taxable income? What can you use that depreciation against?
Yeah, so if we're talking real estate, which the IRS inherently considers passive, right? So when you get that depreciation loss or deduction, that's considered a passive loss, which means you can use that passive loss against your other passive income. So that's a great win right there. You could also use it against the rental proceeds that you're receiving for that year. So you're offsetting your current rental income that you're pulling in. Any excess that's left over can offset any other passive income. And if you meet certain qualifications, real estate professional status, and some of these other things that are available, that could possibly flow through and offset some of your other active or ordinary income as well. So there are levels to it, but it provides a great tax benefit.
And that is really kind of what it's all about, because it's not how much money you make. As we all know, making money, as much as nothing's easy, making money is a lot easier than keeping it out of the hands of the IRS. And not that we don't all have our causes, as Alvin is very clear. The Hope Foundation does a lot in creating the value for behind the charter and behind the things that they do, and there's a purpose to that. But even in that regard, it's a lot easier to attract people to your mission, Alvin. I think this is kind of where you found and delved into this really pointedly with the gentleman that you mentored under. Was you got to understand that you could attract more investors if you gave them the kind of returns plus something, and then got your mission accomplished regardless of what they thought about your mission or not, if you could get them the right kind of tax benefits and tax structure, which is back to the original part of our conversation where the IRS has set this up so that it will attract people that aren't concerned about your mission to take part in your mission because of the tax benefits to them.
Zig Ziglar said something like that if you can help enough people get their dreams, make their dreams come true, yours will come true. I ad-libbed that a little bit. But.
Well, that's the Johnson version. It's First Johnson 2:14, I think is what that is. But and that's really kind of the benefit of it. And this is really where I think, Alvin, you and I kind of have a similar mentality. Is when I go to do something, and I know you and I've had this conversation on many occasions. When I go to do something, I think of how I want to do it, and then I involve Larry in it so that I can do it in the right way.
Right.
And then Larry thinks on it for a couple of days, and then all of a sudden Larry wakes up in the middle of the night and sends me an email like he did last night on this deal that I sent him. And he says, this is the most tax-advantaged way to do what you're trying to do that will allow your investors to get the biggest return for their money. And I'm like, now see, that's exactly what we wanted, because then it's benefiting everybody all the way around. Our mission is accomplished. The AMI is met, right? And to go back to that, the average annual income in America is actually the poverty level is $27,750, and 12.5% of America lives under that, not counting Alaska and Hawaii, and that is only for a family of 4. So, Alvin, what you're getting at is really, really important, and you're helping a community in a way that allows them to be in the area where the jobs are, to improve their status and to improve their ability to earn and to educate and to bring up their whole family, which then elevates the whole community, which is kind of what your mission statement says.
Absolutely. And I think the greatest joy I've had in the last 2 years, I've learned so much hanging around smart guys like you and Larry, so much. But I think the biggest joy I've had, Shannon, is doing what we're doing right now, giving people the opportunity to learn about this kind of stuff so that they can literally change the trajectory of their life. This without knowing, if you don't know, you don't know. You don't know what you don't know. And when we can do this kind of stuff and educate people on just some of the experiences that we've had and some of the things that we've learned over the years, that's been the most fun for me.
Well, and Alvin, I know your story better than probably a lot of people on the call here, but the thing that I know about your story is you got that education. You sought it out. You worked for your mentor. I'm going to tell a little bit of it. Your mentor, you worked for him for nothing. So I don't know that you worked for him. You volunteered with him, and you made him teach you so that you could then turn around and educate your community about how to get from where they wanted to be, or from where they were to where they wanted to be. And
well, I wish I could say that was my mission.
Well, it wound up being your mission when you realized how it could be done for you and for others.
It did wound up that way, Shannon, but
you're getting all bashful on me, Alvin.
No, man, I was just trying to eat, and this guy had a vehicle that would feed me, and I knew if I sharpened his pencil and shined his shoes, he'd keep me around long enough for me to learn something. And that's literally all I wanted to do. I just wanted to be in the company of greatness and learn something. I had no idea where that road was going to take me. And that's the definition of success. Success only happens when preparation meets opportunity.
Yeah.
So I prepared myself not knowing what I was preparing myself for, and then an opportunity popped up. And
the Hope Foundation, came out when Alvin became an obstacle to this man's day until he taught him what he needed to know. Right. I mean,
and then when he passed, and I wound up here, and that opportunity that didn't look like an opportunity, but because I had the preparation and I was not afraid to try something more outside of my comfort zone, this is what has been created.
And how many units do you have inside the foundation, or did you have before you bought out your investors? It's still in the foundation, isn't it?
We had about 3,500 units at our height. Today, I think we're at 1054, just short of 1,100 operating units. In that number, 50% of them are vacant because we're going through major renovations on all of the properties right now. We just repositioned all of them with some tax exempt bonds. It's another structure. So we had the ability to have an issuer issue us some tax exempt bonds, meaning that an investor can buy those bonds and all the yield that he makes off of those bonds is tax exempt.
So now we're getting somewhere too. Larry, explain why. So Alvin, wait a minute. Who issues the bond? How you can't just go get one.
Well, there's lot of state agencies issue them. We had 4 properties in Texas that we got an issue out of Minnesota to issue us bonds because they were just for affordable housing. And so they issued us enough bonds to do 4 properties and do the renovations on those 4 properties. And again, 100% of the income from those bonds is tax exempt for the bond buyer.
So is a bond basically a private note?
Pretty much, that's all it is.
Okay. So you got a $3 million renovation project. You got a bond issuer out of Minnesota that issues you that bond. It's a $3 million bond at 5% or 8 or whatever you're paying.
It was about 40 million total in bonds, really close to it. The rate was about 3.65 in January when we closed on it.
Okay.
And so it's a 35-year amortization.
Okay.
And all of non-recourse for us, but all of his upside, again, is exempt.
Okay. So now, Larry, if you're really thinking about that, what does that translate to for a high wage earner or a high income earner that's going to go in and put $40 million to work? Maybe it's not one person, but I am at the top tax bracket and I put $1 million into this bond. 3.65% doesn't seem like a really crazy great return. I am in a leveraged or in a secured position on the property with the bond.
Mm-hmm.
But what does that really do for me tax wise, Larry?
Well, again, hence the name of the show. It's tax-free cash flow. It's a little bit different than the traditional investment, as if you were going directly into the property or some type of syndication structure. You're investing in these bonds that are essentially the interest that you earn is exempt from federal income tax. So again, albeit most times in exchange for that, it's a lower interest rate. Nonetheless, it's still an interest rate. It's typically more secure, but you're getting that cash flow that's back from your investment, and you're paying tax on it, like literally zero tax on it. And that's the caveat there, which makes it again an ideal structure to consider.
So if I'm paying if I'm getting a regular yield on I got a note, right? I did this and it's not tax exempt, and I got a regular yield coming in and I'm in the highest tax bracket. What am I typically going to be paying?
If you're in the highest tax bracket, you're typically going to be paying around 37%.
So I'm going to be paying 37% on my 3.75. So by the time I get home, I get a 5%, right? So this is really how it offsets for Alvin. He's given 3.75, but the benefit to me is closer to 5.5% yield because I'm taking that extra money that I would have had to get 5% to pay the taxes to get home with 3.5.
Correct.
Yep.
Or you think about it this way, if you've got $100,000 mortgage over 35 years at 3.5%, you may pay back I don't know, call it $250,000.
Right.
$150,000 that's tax exempt.
Right. And the other side of that bond is with the 35-year amortization, this works really well for both parties because the majority of the interest is collected up front. So there's not a whole lot of principal pay down. So this is a nice thing that a lot of like family offices and things like that would like to use because it's long-term wealth planning. We put it into motion, and this is kind of a hedge against inflation. We know that we're using this against some of our other tax strategies. We're able to create that benefit. We're able to create that cash flow. We're able to stay ahead of the tax man. We're able to stay ahead of inflation in most economies. And then on top of that, we're able to do a lot of really great things in the community that then makes it a better place for renters and tenants all the way around.
Right.
Yep.
Well, that's great. I really appreciate you guys. I'm going to open it up. If you've got some questions for either of our panelists along the lines of tax-free wealth growth, apartments, and foundations, go ahead and raise your hand, and we'll take some questions here as we try and wrap this up and get everybody out in the hour we had allotted. Did we miss anything, Alvin, that you wanted to bring up?
I'll jump in and ask a question here while we wait for some Q&A to roll in. Alvin, rewind a year and a half, 2-ish years ago, COVID, right? And rent moratoriums and all that other stuff that was happening during that time. For a lot of the properties that you worked on, I've heard you say on a few occasions that things almost went off without a hitch, right? A lot of your tenants still were able to pay rent, so you weren't greatly impacted by that.
We were impacted to some degree, Larry. I'll tell you, it's so funny in the smaller cities, the tertiary markets, secondary markets. Here in Texas, our renters paid 100% of the rent. We did not have one slow pay. In Dallas and in New Orleans, well, let's take New Orleans. Totally different climate in Louisiana. New Orleans got shut down after the Mardi Gras. Nobody did anything. Nobody worked. Nobody moved. The only way we pushed through that was because we had, I think at that time, about 40% of our residents were on Section 8. So we received 100% of that income. And the ones that continued to work paid their money. The ones that didn't pay were the ones that were on Section 8. And Section 8 only paid a portion of their rent. So if Susie was due for $250 a month and Section 8 paid $650, we got the $650, but we didn't get the $200 because Susie knew we couldn't do anything to her. So, and if somebody's listener's named Susie, I'm not talking about you. Because Susie don't live there.
We don't have any Susies or Karens on, so we're good there.
Okay.
But
so that's how we were negatively impacted, Larry, that way. Fortunately, in Texas, there was some rent relief dollars that came out to the residents. So we were able to assist some of the ones that didn't pay and to go get some of that relief that helped us. And there were some residents that refused to fill out the paperwork and didn't want the rent relief because they knew they didn't have to pay it. And some of those residents got repositioned after the moratorium was
right.
over.
Yeah, we had a very similar thing, and we found that it was worth it to us to send someone around that filled out all the paperwork for them and just helped them, gather all the information.
All they had to do was sign it at the door. And
Yeah.
some of them refused it.
Yeah. But we do have a question here from Celia. If you have a 501c3, what kind of property can you purchase for the organization, and what are the tax benefits?
Well, Celia, what I would say is it has to align with your mission. So if you're a softball club, you can't go buy a bar and think that that's going to fall under your mission.
Oh, wait a minute. There's the whole after game celebration. I think it fits with the mission, Alan.
It might, but it's the IRS not going to like it because they don't drink.
That's creative accounting for you, Shannon.
Yeah. That's
But,
the orange jumpsuit accounting.
But with that same softball club, if you're buying a baseball field or if you're buying a dugout, that works. If you've got a bake shop or a cookbook club that's a nonprofit and you want to buy a building to host your kitchens in and bake cookies in it, yeah, you can do that. So our deal is to provide safe, decent, sanitary housing. So we're a housing organization, so we can buy anything that perpetuates that mission, an office building, an apartment complex, and anything that perpetuates that mission, meaning anything that helps us get to the place of being able to provide for that mission.
So let's say that we combine that thought process that Celia has, and we are a softball club, and we want to take a nice piece of downtown property, and we have someone like yourself that's made a lot of money, and they want to help with that, and they want some tax relief. And so they donated to us as the softball club to own and operate for the next 20 years. And then after that, you see where I'm going with this, Larry? How can we make that so that there's a benefit coming into the deal? It now becomes prime development property that happens while the softball club is using it. And then we can move on from there to the development, having used the 501c3 as a place that provided benefit to the community, but also provided tax relief to the person buying and holding the property there for a future use down the road.
Yeah, so there are a number of iterations to look at, and this is where the strategy and planning really comes into play here. So one approach perhaps that you could look at is essentially selling that property from party A to the 501c3. There's this unique provision called the 179 exchange. Well, if you truly are after some type of charitable giving and you sell it below market value, a very unique valuation needs to be done, but you sell it below fair market value, that delta between the sales price and fair market value could potentially be a tax deduction that's waiting for you. And you've also fulfilled your mission of getting that property over to the nonprofit organization. Or you could just gift it, right? You could gift that appreciated property over to the nonprofit, and tax deduction is there waiting for you as well. And then the nonprofit now owns it. They go on and operate and do the things that they're chartered to carry out to do. And those are just two just kind of quick off the cuff ideas. But there are a number of ways to slice that kind of a strategy.
So Celia goes a little bit further, and now I kind of know where she's going. So can you buy a vacation rental to give away vacations to underprivileged families, specifically with organizations like Make-A-Wish?
I would say yes. As long as your 501c3 is chartered to serve that population of family.
And I'm gonna give the classic CPA accountant answer that everyone hates. It depends. Certainly layers to it, but it also depends on what you're ultimately trying to accomplish. There is a way to get what you're trying to get done, but strategy.
Now, here's something that I've done, and again, you're going to want to consult your tax professional. Mine happens to be on the call here. But one of the things that I've done is I have given to Make-A-Wish, I've given 1 week at a vacation property valued at X dollars, and I can back that up with the fact that I'm renting this property out. I get $5,000 a week for the property. I'm going to donate a week to Make-A-Wish, and Make-A-Wish is going to give me a $5,000 receipt for that donation. That way I'm able to look at it and go, well, I can make this many donations to offset the income from this property, and I can do some planning that way, and I can donate, let's say I donate 3 or 4 different weeks to different organizations like Make-A-Wish, then I don't necessarily need to set up a 501c3. I can just make the donation of the time that they can get to use.
That works. Well, I understand that, Shannon, because basically you're offsetting your income by doing that. It's the same thing as buying it in a nonprofit name, except I like your way better.
It's a lot less complicated, right?
Yeah, it's a lot less complicated.
I mean, it's the contractor version of what Larry can do on paper, right? So then I'm looking at it going, I'm going to make $20,000 in income after expenses, so I'm going to donate 3 weeks at $15,000 a piece or $5,000 a piece to these different organizations. Then I'm having a $15,000 tax credit from the donation come in against $20,000 of income. At the end of the day, Larry, wouldn't I be about a $5,000 income, depending on what my tax professional says?
There you go. I was going to hit you with that answer. It depends.
Yes, sir. Yes, sir. So I think that answers her question. Does anybody else have any questions before we wrap this up today?
So thank you for your question and that I hope there was an aha light bulb moment and not a ha you laughing at us.
Well, yeah, she's laughing with us, man. But while we wrap this up and wait for any questions, I want to thank both of you for coming on and spending your time with us. Alvin, I really appreciate your mission. I know your heart is where it's at with what you're doing, and you've learned, and I've watched this with you. You've learned how to take your mission and combine it with a way of life to make your mission make money for yourself and others, and then you're aligning your passion with what you got to do, and I've seen that in you, and you've always enjoyed what you do. Larry, I have no idea why you got involved with accounting. I don't. I mean, I get what Alvin's doing. I have no clue what you're doing, my man.
It's my opportunity to meet cool guys like y'all. So here we go.
Man,
Larry's in his early 30s. And he is creating such opportunities for us and people like Celia to pay only our fair share of taxes.
Right.
That it's going to put him in such a place in the next 5 to 10 years that by the time, Shannon, he's our age, he won't be doing taxes or construction.
No. Well, and the other thing that I see, the thing that Larry's helping me do is, look, there's a lot of causes I want to donate to. It's not missiles in Iraq. So I'm able to free up my time and my money to do what I want to do with it instead of just throwing it at the IRS and letting them decide where my tax dollars go.
Right.
So anyway, well, it looks like we don't have any more questions, but I want to thank both of you guys for coming on our show.
You, man.
And Larry, we're going to be doing it again next in 2 weeks, June 2nd, as you jumped into that one. And we're going to talk about the tax benefits of ground-up industrial development in smaller markets and show people how we can do tax-free wealth building in that regard as well, so we can create tax-free cash flow. Alvin, always great to see you, my man.
Yes, it is. We need to catch up again real soon, and send
Yes,
me the
sir.
link for next week so I can watch that.
You'll definitely have it. Thanks again, guys, for showing up. We appreciate y'all.
Thank
Dream
you.
on, dreamers.